Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for what is it now? Wednesday? No, it's Thursday. Yep, I took a day off. I'm off by a day, guys. Thursday, February 12th, 2026. It is 2:07 p.m. as I'm starting the video, and here's what we're gonna do. As always, or as usual, I should say, start out with the equity markets. Just a brief update. Somebody asked my thoughts on the major indices, and my reply was no change in the technical posture nor my outlook. To recap, especially for anyone new to the site, we're just catching up. We're in these multi-month trading ranges. There's that key October 10th low I've been harping on since October 10th. That was also the first of two targets on QQQ, which were hit after we had multiple sell signals and objective short entries there as a swing trade. Seems like forever and a day. We've been in this trading range, locked in there. And like I said, sooner than later, all things must come to an end, and this thing will break one way or the other. And so the second part of my reply is, so there's no change in the technical posture. I guess other than, well, no, we were below. I highlighted that the other day. The midpoint of the range often delineates those micro trends within top half, bottom half. It acts as support resistance. And as I mentioned, we broke down recently. And as you know, as predicted, when we're at the top of the range, the next stop would be the bottom. That's the MO in these trading ranges. And we made a perfect tag. It's not shown here because it happened in pre-market. As you guys know, I often get pre-market posts out too with the charts, and I can only turn them on for that day. In other words, there's no way to turn on pre-market trades for each and every day. So I got out to the time we were down. QQQ was right on that level, so the candle at that time looked like that. The reversal, as they often do, they come reversals once support levels are hit. I've noticed that for many years. I mean, there's a good example, the grab trade I got out to yesterday. I mean, I've been doing this for a long time. I will watch stocks after hours, and it's just as common they hit support, especially on earnings reports. They hit key support levels or bounce to price targets in the after hours or pre-market session as they do in the regular session. So that's what happened there. We had a bounce, so it was that drop. And then, as I had mentioned quite a bit, midpoint in the range acts as a resistance. And so we last few days tested the midpoint and the 50-day moving average. Turn off all the lines. That's the yellow line there. That often acts also as a shorter term moving average support and the and resistance when you're below it. Took a while, but you regained it there. That was just an intraday pop right there, or 1 day pop and recovery, and that's that. So as mentioned the other day, that was an objective short entry at the midpoint of the range, and we're down back to there. And unless we clearly take out that 589 support, which again is the October 10th lows, and T1, which was hit right there, that's what we have, and get used to it. But again, we're batting, probably near 800 plus on swinging individual stocks long and short. This has been a great swing traders market for individual stocks. A stock pickers market is what I really should say, where again, the major indexes are going absolutely nowhere for months now. There's a lot of individual stocks that are absolutely going places. And so that's what, as always, I'll continue to pump those ideas out in any kind of market conditions, but just continue to reiterate that's where you're going to make the easy money on individual stock picking right now. The only way to make money on the indexes lately is by active trading using very short-term charts. All right, so that's it. I still expect the downside break. That was my reply today. And then, as I've been saying, the 200s come in so close to that level. And again, it's been my expectation all along that I think just because of that energy building like a coiled spring, once we break down below, we'll probably just power right through the 200s and then hit T2 and then probably come up and back test them. I don't know, guys, because this is, again, going on a long time. A lot of potential energy building up. And when that energy is released, you could have a pretty powerful move. But I've got something else for you. I'm not going to go over I'll go over some of the Mag 8s, not all of them right now, because I just did that yesterday, I think. NVIDIA, again, at the top of its multi-month trading range at box I just drew right there. And so again, just like QQQ, I expect the next move will be down to the bottom of the range. And then below, you have the 200s come in as well. And they're not going to report until the 25th, but that's coming up on us. And so this is the way I think it goes after earnings. And that's how they trade after earnings will impact where the stock market's going again, because it's the biggest component. Apple, I mentioned recently, after we closed out that short trade, we entered there, hit 1, 2, all three of my targets plus the 200-day moving average, good for a bounce trade off there. And then I mentioned I didn't have the highest degree of confidence. I didn't put it as an official trade. I told you it'd be an objective short here at that 277-ish resistance or on a break of the trend line. The trend line broke, and so now Apple's going back down. That's helping take the markets back down with it. And as I told you on Apple as well, I like to use the PPO zero line. In this case, I have a 0.-2 trend delineator right there. In other words, I look at the 9 EMA. It's the PPO signal line. That's the last of the two to cross. It helps avoid whipsaws. And it's simple, as I've showed you many times. When it's above that line, the trend is bullish. You want to be long and strong. And when you cross below, the trend is bearish. Time to be short or out of your longs. Cross back above there, bull trend. And recently we crossed down below when we were already, remember, we were already short this stock before that cross below. We hit our third target. And that's another reason, and I covered this just recently, why I maintain this likely would be an objective short entry, and we'd likely fail there because this was a back test of that level. Remember, this line acts as support and resistance. Now we're a hair above it. Again, sometimes you'll come bounce a little bit above it right there. And sometimes I'll even tweak the line or adjust it over time. It will change on every security. Again, you can see back here, that's where it bounced once we recovered it. And that's what's being tested now. So give or take, we're talking 0.52 there. So we're talking about a half point range there around the zero line. And so that's that. And again, the rest of them, the check marks that I've given you, alphabet breakdown, backtest, rejection, but it really needs to clear out, solidly take out that 313-ish support and the 50-day that it's testing right now, which is clearly my expectation. Again, this has been and is currently one of my favorites. Apple was a favorite a few months, a couple weeks back when we shorted it. Then I said we milked that, we sheared all the meat off that bone because we hit our third target and bounced. And I'm looking for the same thing here with Alphabet. Pull back to the 200s, just like we shorted Apple back to the 200s. And again, if it does do that from the recent highs, that's going to be a drop of about 25%. So, and from where we're at now, that's still going to constitute a drop, depending if and when we get there, at we'll call it about 15 or so percent, if that happens, and that would have obviously a big impact on the market. So Microsoft still, they back tested and still below that trend line there. So that gives it keeps it bearish unless it can get above 422, 423 right there. It's in a bearish technical posture. And again, nothing's changed my long-term outlook. I've given you these arrows I've drawn here months ago. Those are initial breakdown. These are the zigzags, and this is where I think ultimately in the coming months, sometime probably this year, certainly no later than next year, where Microsoft is going, and that's a whole lot lower. That's going to be a total drop, again, if that T3 levels hit, of about 65%. And I know many think that's complete and utter heresy, especially among stock market bulls. But it's just how I see the charts, where I think it's going, lines up with everything else I'm seeing. But the thing about it, right or wrong, if Apple goes the other way, I'm certainly not going to be short on a ride up to 600, 700 in Microsoft. I might have just called it Apple, I meant Microsoft. That's that. So, but again, where is it right now? Well, coming up on, this is my weekly chart. We're on here. You've got this, this is a 200-week EMA. It's access support, so I want to see that taken out. And that will increase the odds. Microsoft, I keep calling it Apple. Microsoft's going lower in the whole market. Amazon, nothing but check marks across the board. Divergent high, breakdowns, check mark on the primary trend line break. Again, this trend line goes back quite a bit to the left of the chart. 200s were taken out. That was that other check mark. That's supposed to be check mark. They had them green question marks before, or red, because I was waiting for that. That already happened. And then my 211 lights out level on Amazon, as I told you, this was a support shelf right here for many, many months, going back to really the early May last year, and that's been taken out. So that's plenty of check marks on the Mag 8s. And then I'm going to get to financials in just a second. And then Meta, I've covered extensively. The 200s taken out here, back tested, little earnings pop, which failed. But again, we're hugging the 200s now. If I turn off all the other lines, you can see the red line here. I'm going to draw it. They come in together. The blue and red lines are your 200 simple and exponentials. And so right now, it's below, but not by a lot. You want to see it start to move away. It already lost the 200 simple there, and it's an incremental thing. Each tick lower, it becomes more apparent to the masses that Meta has lost its 200s. Right now, you could say, be a glass half full guy or gal and say it's simply a back test that recovered them there, maybe a slight undercut, and we're going to do that. But again, you start getting away from it, and that's where traders start to realize it, and more stops get hit on long side traders. All right, and then more short sellers will pile in. So that's Meta. Broadcom, still waiting on earnings, March 4th. So we got a few weeks to go. Major sell signals to come. This is pretty much it. About 308.55. Once that happens, you'll be below the 200s, which it's currently testing. You'll be below that purple uptrend line. And then that's another big one of the Mag 8 stocks. Tesla, as I mentioned recently, just had a pullback, tested the 200s, bounced, and that's it. Needs to take the 200s and then take out 361.50, and then that should be lights out for Tesla. But until then, again, this is a grind. Recognize it for what it is. It can go either way. I completely respect and understand that. There's that box, if you will. This is the that early November low needs to be taken out, and this reaction low right there. So that's it. So really above that recent low should do the trick, because the 200s will be lost because we just tested them. So any low much below that recent low should do the trick there. Okay, and finally, financials. If you've been following me, I've been waiting. First, I wanted to see a failed breakout. That breakout to all-time highs right there. That was the previous all-time high, 54.50-ish. Broke out, did it with a divergent high overbought conditions. So it was my expectations it would fail. That was a check mark when it did fail. That was the right here. Watch for failed breakout. And I kind of had to move that away. Check. And then, like I said, we were testing this support level, 53.10. So 53, I said, had to go. Check. And then the 200 days, which were perfectly tested right there, you can see. And as of now the day is still kind of young. We have an hour and 40 minutes left in the trading day. We're right now at 52. We're a little bit below the 200s. Again, the redder the better. So if we can close down here, that's a clear loss of the 200s. If they save it and park it back on or above, then that's just another successful test with an intraday break, the 200s. So as of now, I'll take it. It helps, certainly to see this 53.10 level go, and it helps that we're below the 200s. But again, the day is young and the week is even younger. Well, no, it's getting kind of old. I forgot it's Thursday, right? I keep that day off I took on Tuesdays got me behind a day. So, yeah, we'll see how we finish tomorrow. And then this is really, I think 51 will seal the deal. It's price support, and you get below there. That's today's low as well. You're going to have clearly taken out the 200s. And like I said, this, in my opinion, has been the one pillar holding up the market, especially the S&P and Dow, which have higher weightings. And there's virtually hardly any at all financials in the NASDAQ 100. And we know that the market leaders, the Mag 8, have been just weak, stalling out, but they haven't been completely taken down. Again, you want to see all of the majority of them below their 200-day moving averages. And I've already spent a lot of time on those Mag 8s. But and that's because tech is the largest sector of the S&P 500, by far the largest of the NASDAQ 100. But in the S&P, financials are the second largest weighting, and it's about a 14% weighting. So it's still as big as that is. It's only half of what tech is on the. But again, second largest sector. So if it breaks down, again, take out 51, start going lower. It's clearly my expectation, especially when I toggle over to the weekly chart. Paints the bigger picture for me. I'm scrolling back, going back here's the financial crisis right here, the Great Recession. And so we embarked on a great new secular bull market we've been in since then. And in that bull market, we can count them: 1, 2, 3, 4, now 5 divergent highs, clear negative divergence. And they've ranged from drops. That was a quick one there. It was a flash crash back in 2015. If you all remember, that was a 26% drop off that divergent high there. Let me turn off my line so I can measure for you. We had a quick 28% drop from this divergent high. Again, I said COVID wasn't random. It was priced into the charts. It might be considered a black swan. I can't argue with that. But again, a correction or bear market was priced into the charts due to the technical factors. 43% drop. And it is what it is. Again, it's technicals. And then this one right here was about a, give or take, 30% drop. In this one, I expect nothing less than a 27% drop from the recent highs to this, at minimum, again, at minimum, to this uptrend line here. And quite likely, before all said and done, back to this level right here. This is my longer term swing target right here. A target that I think has a good chance of being hit this year, and if not this year, certainly next. And remember, stocks tend to fall a lot faster than they rise. So you can see right there, we need to take this out. There was that breakout to all-time highs, this little trading range there, and it's pretty thin. So I think once the financials break clearly below 51, we shoot down to this target. They'll buy it here. You can cover short. Again, if the market confirms, if you can make a case to go long, the NASDAQ 100, most of the Mag 8s and things like that, bounce it there, go long, wait for that to break. That's kind of what I see in my mind's eye, how I think this year is going to play out. And I take it one step at a time. If we never get the breakdown here and we go up, then guess what? I'll be talking about the same thing, 3-6 months from now. But based on the scope of the divergences, how long they've been building, the charts, I think this is ripe, ready to go sooner than later. So that's it. That was the most important thing today, is that breakdown right there. I just got you an update. I had to step away from my desk briefly today. Had a little HOA meeting that I'm a member on the board, was just down the street. So I'm back at my desk now. And there's that breakout in TLT. It's taken a minute, but we finally hit our second target today. Remember, after closing out this short, we shorted TLT right there. We hit 1, 2, 3, all 4 of my targets. Then we turned it around, as I often like to do, turned it the other way, went long right here, quickly hit my first target, a slow grind around, went down, but not enough to violate any reasonable stop to the final target. So it's still been just one trade and just the same basis for entering it there. Positive divergence just got bigger and bigger to this point. And then I give you an update there. When we recovered that was bullish, and that was a re-entry point or an add-on or a new entry. And boom, pretty straight shot up to T2. This is what I like to see. Financials broke down today. That was one pillar I've been waiting to see cave. Again, there's additional check marks to come, additional support levels I want to see go, but it's certainly a start. And it's no mere coincidence you're seeing the market down today and you're seeing treasuries rally. As I gave you before, that could either be a pure play long trade when I give you the trade idea mid-December, or an indirect hedge to index shorts. Meaning, treasuries go up. If everything works out perfectly, that's why I like these indirect hedges. We can make money on both, and we have. Both trades are profitable: the QQQ short and this current TLT long. And this is what we call flight to safety bid. Stocks get sold. The institutions start moving money. Think pension funds primarily. They have to, cover their, make sure they reduce risk exposure. So they'll start buying treasuries and selling stocks, and then that's it. And then, let me cover this real quick. Okay, this is mainly for anybody new to the site. I'll cover a couple more things and wrap this video up and make it kind of short, get it out to you guys. I've covered this before, and I've covered it on other charts that even show it a little clearer, but because this is not log scaling, this is linear or arithmetic scaling. I've showed you in log scaling as well, but the blue down below is FINRA margin debt. That's again, I've covered this before. If you open a brokerage account, your broker, and it's a regular brokerage account, non-cash account, meaning margin. Most of the time, they're just gonna, even if you don't ask for it, they kind of slip that paperwork in, rehypothecation agreement, where you're agreeing to lend your shares of stock out. Your broker can borrow them, give them to someone else. They don't leave your account. It's a ledger transaction, and so they can, people like me who like to short, and institutions can short those shares. And but 99% of people, I don't know what the stats are, but it's almost everybody. The vast majority of traders are bullish. I know that. I realize when I do this site, I put out so many short trade ideas. I know most of you don't take them. I get that. I love to short gains, but I love to make money. I don't care if it's long, short. I don't care if I'm trading crypto, orange juice futures. If there's a chart, it's clear that it's going to go one way or the other. Doesn't matter to me. Long, short, up, down. Just got to pick the trend. But where I'm going with this is most traders are bullish, the majority, especially individual, even institutions by far. Don't get me wrong, it's actually probably equal. And they only go long stocks, and they buy them in a bull market. They tend to use more and more leverage, and after long enough period, they're like, well, why am I making my Nvidia keeps going up month after month, year after year? Why don't I borrow on margin and buy even more and magnify my gains? And then every bull market ends with a peak. And I've showed you this isn't my favorite. I just queued this one up. I had, again, if I put it in the log scale, you see almost a parabolic lift and an increase at the end of a bull market. This was the dot-com bubble. And this red line here is just the S&P 500. It doesn't look like much. Remember, the dot-com bubble was mainly about the NASDAQ 100 and tech stocks, again, things with .com, but then anything in the tech sector got killed. The NASDAQ fell by nearly 80% off the highs. That's an index, not an individual stock. So that means stocks in there, a lot of them went to zero, fell 100%, 99, 90 plus, and that was that. So these were the two real bear markets in the last several decades, and some of your, some people listen to my voice in your entire lifetime. The last other real bear market before that, where you got to go back to the 70s, early 70s, and either way, because they ran their course. Then the Fed came in, and they figured they could just QE forever, and they just kept keeping rates at zero, and then hitting the the nuclear button when COVID hit, and that's just kind of again, I use the analogy of just putting way too much. Patient comes in, walks into the ER with a head cold, and they just pump them full of epi. That's what the epinephrine, adrenaline. That's what the the central banks and all the federal government. It was not just the central banks. It was fiscal and monetary stimulus, and so we got all that in the residual effect there. But we peaked right there, and you can see margin hit an extreme. Market had a bear market back then, 2022. Went to new highs, and this is where we're at. So we're at, again, we've gone nearly parabolic, and this very much, I just wanted to cover this, very much plays into my longer term outlook. And I listen to people that, they are intelligent, don't get me wrong, they just see things through a different lens than I do. The so-called experts that come out on TV, Bloomberg, CNBC, the ones that, write in the Journal and Bloomberg, and they just can't foresee because these what I'm going to call BS on now, the government statistics on employment and all that. And again, corporate earnings, I get it all. Record earnings growth is healthy. Credit spreads right now aren't wide. Now I will acknowledge that. That's the one thing that's kind of kept this market going. Credit spreads continue to be very narrow. I believe they're mispriced. I believe there'll be a blowout in credit spreads sooner than later. And again, what's going to happen is, as always does, once this ship starts to turn, the top, again, whether it happens in 2026, whether it's already happened, or, and I'm talking in, the NASDAQ 100 and to where the S&P, or it happens, later this year or next year, this turns. And it doesn't matter how healthy earnings are, how healthy, even the job market. This is a vicious cycle that selling will more selling. Stops get hit in this bubble, and it's always happened, starts to unwind. So if you've ever looked back, and that's all I do is study history, study the markets, and wonder how when these bear markets hit, the markets can drop 50, 60, 70, 80%. It is simply that. It's that unwinding of a debt bubble on margin. I've explained it pretty simple. You put 100,000 with your broker, you can turn around immediately buy 400,000 in stock. And people do that, but they tend to do it not here when valuations are cheap. It's FOMO. When valuations are super high. So again, guys, this is not a timing indicator. This can go higher. And there's no end. What are the timing indicators? Are the things that I started the video with, the Mag 8 stocks, the NASDAQ 100, the S&P 500, the sectors that are holding the market up, the important ones, financial. Again, utility stocks, they can blow up. The sector can drop 80%. It's not going to move the needle on the S&P 500. Why? I'll tell you why. Because XLU accounts for, do I have it written on this one? No, I don't. Going from memory, I think utilities like between 2 and 3% weighting in the S&P 500. So it really doesn't matter what they do. Now, if you want to trade them, great. You can see this one just broke out of a triangle pattern there. It's also a defensive sector. So when you see utilities going up, just like I've showed you recently, consumer staples, that was a sector I've highlighted recently, been going straight up. This is indicative of sector rotation that comes in late stage bull market or late stage economic expansion, late in the economic cycle, where institutions will start to rotate out of growth companies like technology and the likes and into defensive issue. Consumer staples and utilities are the two biggest defensive sectors in the S&P 500. Yeah, healthcare can be too, but healthcare is getting kind of frothy. And healthcare is very diversified. There's different subsectors in there. But staples, again, as the name implies, these are consumer staples. Things that you need, not things you want. Consumer discretionary are the things you want, the big screen TVs and stuff like that. Consumer staples are your Crest toothpaste, toilet paper, and the likes. Things that no matter what the economy does, you're still going to buy because you need those things. That's why they're called staples. And so, again, you see that institutions have been very aggressively rotating into that sector, as well as I can show you utilities. So there's a lot of check marks I'm seeing, guys, for those deeper targets that I have on the weekly charts of QQQ and SPY. And then finally, last but not least, I want to get you this one here. Let's queue up ADP. ADP is the best of my knowledge, it's always been, I believe it's still the largest payroll processor in the country, and by far. Paychex number 2. Again, if I'm wrong, you can vet the facts, but I just know that I believe this is the king of them. And I've done this for you before. I'm going to show you again. This is why I call kind of BS on the government's very flawed employment numbers. You get the birth death model, all this other stuff. Look into it, seasonality adjustments, and I've always say charts speak louder. I'm going to compare it here to the S&P 500, to the stock market. And so what you're looking at, so I just put up a white line. You can go back as far as you want. And I encourage you to do this on your own. I've covered this before. I'm going to take this, zoom in back here. I'm on a weekly chart, so I can go back. This is the mid-90s right here, late 90s. You can see a nearly perfect correlation between ADP, which are the yellow and green candlesticks, and the stock market, right? And it makes sense. Their business model is very simple. They're a payroll processor. So if there's more job creations, they're getting more business. Every single person that a company puts on a payroll, assuming nobody's laid off, to offset that is just an extra, it's their business model. They're making more money, and more payrolls are processing. And so it ebbs and flows. Remember, the stock market ultimately is a reflection of the economy. And you can see, hopefully you can see it here, near perfect. Again, I'm going through time here. Near perfect mirroring of the, let me go to, I zoomed in here. Let me go back. Yep, there it is. Near perfect mirroring of the economy. When we crashed here in 2020, ADP fell right along with the S&P, went back here. The only divergences that I spot, and I just took it back as long as I can go. I went back decades. The only divergence was right here, the second, other than the current. This is where the S&P, remember that correction we traded down in 2022 right there? Bear market correction, whatever you want to call it. ADP was telling us a different story, saying no. Job market's strong, and the job market's everything. If you know that anything about the economy, if there's just one thing to watch, it's the job market. Consumer spending is 70% of GDP, 2/3 of 70%. And so while stocks were going in a bear market, this was the only divergence, anything remotely close to, direct one going the other way, the other going the other way. The stock market dropping, ADP going up, saying, hey, it's not so bad. They kind of did a little mean reversion there, but then look right back on track until now. Guys, this is unprecedented. And again, so you can follow as a lot of these, no offense, but I'm just pimple-faced, MBAs coming out of Wharton that are, talking young kids that are running, kids obviously in their 20-something that are, looking at the government data and statistics, which have been flawed historically, but with the shutdown and everything recently, or I don't know what's going on with that strong jobs report. I know there were previous adjustments, by the way. If you really dig into it, people wrote about it. They revised some of the older numbers down. This big January bounce will probably get sold down, or was it December? The last one that just came out. All I can tell you is this is fact. This is what you got to look at. And I don't, again, maybe others are talking about it. I kind of live in my own little bubble, my own little vacuum. I do read headlines, read news feeds, Barron's, Bloomberg, Wall Street Journal, any sources I can follow. And I don't see anybody talking about this. Guys, that's a huge, huge divergence and disparity. And you might say, okay, let's just go with this theory that, okay, Randy set up, from a simplistic view, right? Every new person on payroll is a new, additional revenue for ADP, but maybe they're restructured, maybe something's going on, and they're doing big capex expenditure somewhere, and that's what's bringing it down. Well, just invert it with the second largest one, or swap it out with Paychex. Paychex is telling the same story. Go back as long as you want. Look at the stock market. Again in white, and this is Paychex in green. Paychex goes up, stock market was going up. These lines aren't going to overlap. You look at the trend, the directional trend. They both peaked here. We had a new bull market. That was the dot-com bubble burst. The bear market back then ended in late 02. New bull market, that ended there with the Great Recession. That's Paychex dropping right in line with the S&P 500. Again, there's virtually zero variance in this correlation. Other than this period here, where the markets, we did have a bear market. Again, we traded, market went up, but this was saying, hey, employment's doing better than probably the headline numbers were coming out at the time. I know there was also worries towards the tail end. No, that wasn't even this was the Trump stuff here, the tariffs. That was concerns about a recession. But again, everything got back on track. And this is the stock market, S&P 500 in white, and this is Paychex. So that eliminates any one-off things that may be going on at ADP. When you look at these collectively, it's very unlikely that they're both implementing these huge, whether it's capex spending or some one-off kind of things that's caused their stock price to, it's in free fall. So I would put a higher weighting. Me personally, I put a much higher weighting on this, what these stocks are telling me, what's going on in the job market, than what the S&P is. So that one was a trade idea. We took a shot at it right here. It just burned right through that divergence. We hit our stop. I've already covered this. Max stop's been hit, and this thing keeps falling. Now it's coming up to support. There's going to be a hell of a bear market rally. By the way, guys, so I wouldn't go short in these now. We're coming up on here. I'll look at ADP. Even considering throwing this one out for just, again, nothing else, a bear market rally. Let me turn off my comparison tool here and show you what we have here. Let me turn on my lines. So ADP, you do have a reaction low right here. I'm going to take that line across. You're at that reaction low as well as one right there. But this is really a better spot. You'd be stepping in. You know me, I don't mind catching falling knives, but at this point, I'd rather see it get down here to about 198.43. At that point, it's going to be a bear market rally. This guy already put in a big divergent high, multiple sell signals, including the primary uptrend line off the 2020 lows right there, broken. Um, and that's it. So I just wanted to point this out for those of you that are saying, Randy, your outlook's just too bullish. I'm sorry, just too bearish. And again, guys, I've just spent, how much time going over the equity markets and my view on the stock market. But where we're making money are on these hit and runs, getting as many, if not more, in the last year or so. We've had a lot more long trade ideas. I got grab out to you last night. Hit the quick, just these, in and out, quick targets. That one hit T1. Give you an opportunity to take profits there. Remember, I have the after hour trades turned off. We bought it right here at support. And I'm going to give you, before I wrap this video up, kind of pro tip. I've shared this many times in the past, but again, these things bear repeating because of something I said 6 months ago or 6 years ago. May not, it gets buried, or it's not going to help a new subscriber. On my swing trades, I will, my preference, what I like to do, first of all, I've always preached the virtues of using OCA orders. One cancels another, or OCO. OCO is one cancels the other. OCA, some brokers call it OCA, one cancels another. And that is, you buy a stock. So you bought this one here. That was our first price target right here. And second target's there. So you pick your target or targets. Some people sell half when the first target's hit. Some like to, hold out and wait for the higher targets. Some like to take everything off at the first target. Some like to game little pullbacks. So again, there's multiple price targets, many ways to skin a cat, many ways to swing trade. But the important thing is, you enter here. You're going to have your initial stop. Now, we've already hit T1, so of course stops should be moved up at that point. There's no reason to let a winning trade turn into a losing trade. So usually, when the first target's hit, it only makes sense to at least raise stops to entry. So it was bought here at dual support. An OCO order says you turn around, you buy it, and you're going to set two orders: a stop loss, good to cancel, and a sell limit order or orders, depending on if you're going to take partial or how you're trading that. Also good to cancel. Now, I like to, personally, my stop loss orders, I do not check the box to have them allowed to be filled in the regular trade after hours trading sessions. Because one reason is that's kind of the wild, wild west, especially in a, if you're Apple, Microsoft, they trade very liquid in the after hours and pre-market sessions because they're just so big and the volume's huge. These lesser known names, especially if you ever put on a 1 minute chart, you can see, the stock trading away from, here, let's just let's go to pre-post data, always show last two sessions. So there's where we bought it last night, or at least where I got out to you. And there's where you hit the price target in the pre-market session, and then you hit it again the after hours. So you have plenty of time to exit that trade. And now we're back below there. So there's the reaction off T1. But and again, this was earnings, so there was a lot of volume. But on any given day, you can see these little spaces between the candlesticks. And it's not unusual to see a low volume stock all of a sudden print. I call it kind of an erroneous print, a print way away from current prices. Like this is current prices. Then you get a print right here and you see the big white down candle. And then the next print's up here. That's because some fool had or maybe a smart person put a buy limit order. Someone might have had a sell limit order and somebody saw it. And, that's how the stock market's a matching order. So if someone agreed to sell their stock, maybe they meant to put a buy limit order down here and they marked as a sell limit order, and someone might take that down if if a buyer and seller are matched up, that's where it's going to fill. And so because of that, I don't like to have my stop. The goal of any trade, right? Correct me if I'm wrong, is to not be stopped out, right? So I don't let my stop loss orders get filled in the after hour session, because one of these little weird, spikes down below is likely to get me. So those I marked only to be filled in the regular session. Again, good to cancel. But my goal in any trade is to get out. And so I will set my sell limit orders to be filled in the after hours, or outside regular trading hours is what it's called on, some brokers. Um, and that way, sometimes you get that erroneous print that's away from all the other trades that comes up real high, and you wake up to a gift. Maybe you get up, maybe it happened at 6:30 in the morning, 7 in the morning, and you sat down at your desk at 9 to drink your coffee, and you got filled. So, all right, that's just something that I like to do on those. Again, OCO orders, stop loss orders only to be filled regular hours, sell limit orders to be filled outside regular trading hours, and as well as the regular session. Okay, guys, I'll just quick update on silver. That was the bounce target range I gave you. Right after that, we caught that big drop, biggest drop since 1980, I think it was. And then give you a bounce target range, which we hit right at the bottom of, and we're still below it. So you can see we did a good about a 38.2 retracement off the initial drop there. Gold was closer to the, I think, 61.8. 50 on GLD. Futures, I think, did 61.8. Again, I'm talking about Fibonacci's I put up there. And that was the blow off top, the initial drop. This is my Fibonacci retracement line here. This is the 50% midpoint, meaning we retraced half of the move up. As I told you before, that's typical on a counter trend bounce. Give you a bounce target range, and so that's it. We so far hit the midpoint of that range, and that's it. So I'll continue to update that. Bitcoin's still below the resistance level I've covered just recently. Again, if you have questions on it, just bump me. I may just post. Sometimes I'll just post if I just covered it yesterday, like Bitcoin or whatever. I'll just give you a link to my last update if nothing's changed. I think that's it. If I forgot anything, I'll add it to the comments section below this post. As always, if you have questions on any of the trades I've shared or anything else, anything you're watching, like I say, I get a lot of trade ideas come from folks like you on the site asking me about something that might not be on my radar at the time, and I'm like, oh yeah, that looks great. And then just yesterday I updated the VIX. I think it was yesterday or the day before, highlighting that the VIX has woke up. We're coming off a divergent low, an objective long entry on the pullback to this trend line. So if you took that, added to or entered the VIX well, futures are the futures. Depends if you bought the near month or the next month out. Near month contracts are probably up that much, close to it. 24% bounce so far off that trend line I gave you yesterday. So VIX is certainly waking up. And again, if we break the October 10th lows, especially on both SPY and QQQ, expect the VIX to move very hot and fast, like it does. That's nature of it. It's not, it's not rocket science. This is when it's a very constructive looking chart, just like the stock market to me is a constructive looking chart in reverse, constructive for shorts, for bearishness, and that's all. So the VIX is just it's a leverage play, but don't trade it if you're new to trading, investing. If you have a very low risk tolerance, in that case you should be an investor. I think a trader by definition you have to have at least a fair amount of risk tolerance. But and there's that same uptrend line I gave you on the 60 right there. So that's what. And look, sometimes I'll tell you the VIX will sometimes violate these trend lines just because. So it's not a hard okay. Well, if that breaks, we're going to go to new lows. Again, I would start to be concerned at this point if the VIX fell below this. I have a line here at about 1463. And that will be if the indexes make another run, get back above the upper half of the trading ranges, and especially make a run at or above new highs. We're probably going to fall down here if the stock market, both QQQ and SPY, break out to new highs. But that is not my expectation, has not been, nor is. I still see lots of potential, especially if we take out the 200 days in the market. You're going to see massive position. And this is the beauty of it. The institutions are all caught off guard. Everybody's bullish. I know that from reading that jobs report that came out the other day. And you see a quick move as institutions and individual investors. It's a combination of everything. They buy puts to hedge up against their long positions. They also sell longs. Stops are hit. We have a huge amount of margin interest right now. Bitcoin's been imploding. That's a big thing, I think, in the stock market. And the silver bubble and gold bubble may have popped permanently. May just be a correction, sharp one, but that bubble may have popped too. And again, a lot of people were piling in that trade at the top because it was going parabolic, and so that helps to exacerbate that unwind of the margin call. If those risk hot assets, the assets de jour, which again was silver and everything else, if they start to fall, selling begets more selling. So either way, I'm going to stop it here. You guys know the levels to watch, and yeah, I'll continue to hunt for some new trade ideas. This has been Randy Finney with Right Side of the Chart. Have a great day.